Alright, this is a paper called Momentum Strategies. It's written by Louis Chan, Narasimhan Jegadeesh, and Joseph Lakonishok. It was published in the Journal of Finance in December 1996. Okay, let's jump into it. So there's a lot of literature out there about the persistence of returns. So DeBond and Thaler back in the 80s found that past losers outperform past winners over a 3 to 5 year period. Jegadeesh and Lehman found short-term reversals, and then later on Jegadeesh with Tipman found that past winners outperform past losers over a 3 to 12 month holding period. And so even before all of these studies happened, investors have been exploiting this momentum strategy of buying past winners and selling past losers. And so the style's so popular, it's become a style of its own in the United States and other equity markets. And so this momentum style kind of conflicts with market efficiency. So a lot of explanations have come about to account for why these reversals occur. So other studies have found that maybe it's caused by bid-ask spread, maybe it's a lead lag effect between stocks, or maybe investors tend to overreact to new information. Or it could be related to book-to-market effects discussed in a lot of prior papers. So really the situation of stock price momentum is very difficult because there's a lot of controversy in the studies that have been done around it. So it's been found that these long and short-term reversals are in fact happening. However, there's not much information out there about why. And so without a why, there's little rationale for the validity of the momentum strategies to stand on. And so if there's not a reason found for why these momentum profits happen, maybe that means that the strategy actually would not work out of sample, and that actually the momentum profits are just a fluke. And so in this article, we want to try to trace the sources of the predictability of future stock returns based on past returns. And so naturally, earnings may be a reason, so that will be explored in this paper. And specifically, that is searching for evidence around the market's underreaction to earnings information. Because it's been found in a lot of prior papers that firms reporting unexpectedly high earnings outperform firms reporting unexpectedly poor earnings. And that happens over a period of 6 months after the earnings announcement. Likewise, a couple of authors found sluggishness in the response of prices to revisions in analysts' forecasts of earnings. And so maybe the profitability of these momentum strategies is entirely due to the sluggishness around earnings-related news. And if that's true, then the momentum strategies won't be profitable after accounting for these earnings announcements and forecasts. And in that vein, some other studies have found that Value Line, who uses earnings and price momentum strategies, earns its abnormal returns pretty much entirely from earnings surprises. So the second possibility for why momentum strategies happen is due to the overreaction induced by positive feedback trading strategies. And so this would be due to trend chasers reinforcing movements in stock prices, but without regard to the fundamental information of those stocks. So eventually the returns will reverse to be more in line with fundamental information. And so finally, the momentum profits could be due to both earnings momentum as well as price momentum. The earnings momentum may benefit from the underreaction to new information about short-term earnings, while the price momentum may benefit from long-term or longer-term prospects. And so in both cases, the strategy may be individually successful and maybe doesn't cannibalize the other. For example, the earnings of a company are only the accounting numbers. However, there may be other prospects for the future earnings of the company. So then the price momentum may show a persistence in prices while the earnings could possibly be weak at the same time. In addition to exploring those different earnings and price momentum trends, this paper is going to provide a comprehensive analysis of different earnings momentum strategies on a common set of data. So each of these different strategies will differ on how the earnings surprises are measured and give kind of a different perspective. And so commonly when trying to measure the earnings surprises, there will be a model that uses the expected earnings plus the unexpected earnings. However, calculating the expected earnings is somewhat spurious, so it may give errors in the specification. And so it may be easier to use analysts' forecasts of earnings, which haven't really been used in the academic literature, but may provide a more direct measure of expectations, and they're available on a more timely basis. So a lot of investment managers use analysts' forecasts in their expectations for earnings. And so looking at the abnormal returns around earnings announcements, we can objectively look at how the market reacts to earnings news. And interesting in past paper, the unexpected earnings affect future returns. However, the actual returns immediately around the announcement date do not have that power. So having said all that, this paper intends to clear up a lot of the conflicting issues and try to find what momentum strategies work around earnings announcement, and to try to disentangle the relative predictive power of past returns and earnings surprises for future returns. And they're also going to provide some evidence on the risk-adjusted performance of price and earnings momentum strategy. And in doing so, they confirmed that drifts in future returns over the next 6 to 12 months are predictable from stocks' prior returns, as well as their prior news about earnings, and that each momentum variable has separate explanatory power for future returns. So one strategy does not overtake any of the others. And they find that there's no reversals in the returns later on, so maybe the positive feedback trading cannot account for the profitability of the momentum strategy. And they find that the companies ranked lowest by past earnings surprise are persistently below average in the following 2 to 3 years. And they find that analysts' forecasts of earnings are slow to incorporate past earnings news, especially for the firms with the worst past earnings performance. And so they find that the bulk of the evidence thus points to delayed reaction of stock prices to the new information in past returns and in past earnings. So their paper is organized like this. Section 1 describes the sample and their methodology. Section 2 has univariate analysis of their different momentum strategies. And Section 3 has the results from their multivariate analysis. And Section 4 examines whether the price and earnings momentum are subsequently reversed. So Section 5 tries to determine if their results are robust. And Section 6 concludes. Alright, let's look at Section 1, sample and methodology. So it looks like they use all domestic primary stocks on the New York Stock Exchange, the Amex and the NASDAQ. They're excluding all funds and REITs, ADRs, and foreign stocks. And since they need earnings information, they're using companies that are covered by CRISP and CompuStat. And whenever information is not available here, they're going to use the analyst forecast from the IBES database. And so at the beginning of every month, starting in January 1977 to January 1993, they will rank the stocks based on the past returns or measure of earnings news. And so to be able to be part of a portfolio, the stock need only have the information necessary to be ranked. So that may either be the earnings or the past returns. And the ranked stocks are then assigned to a decile, and all the stocks are equal weighted in each of the decile portfolios. And so in the price momentum strategy, they're using the stock's past 6-month returns as the ranking. And for the earnings momentum strategies, they use three different measures of earnings. The first is the SU, the standard unexpected earnings, which was used in some prior papers. And the SU is calculated with this equation. And so the SU for stock I in month T is equal to the most recent early earnings per share that was announced in month T minus the earnings per share that was announced 4 quarters ago. And that's divided by the standard deviation of the unexpected earnings, which is this, over the last 8 quarters. So basically they're saying what is the difference? It's a percentage of the current difference over what's normally that difference. So is the current earnings surprise more or less than what it normally is? Okay, so then another measure is the cumulative abnormal stock return around the most recent earnings announcement, the ABR, and that's calculated here. And so we have here the return of stock I on day J exceeding the equally weighted market index, and then that's summed from the 2 days prior to the earnings announcement to the day after the earnings announcement to get sort of a 3-day return of that stock exceeding the market or underperforming the market. And in comparing this ABR to the SU, the ABR looks at a small 3-day period of returns. However, the SU looks at a number of quarters, so you could say the SU maybe is a longer term look at around returns of earnings surprises. So the last measure is the changes in analysts' forecasts of the earnings. And so this is calculated as Rev 6, which is basically a 6-month moving average of past changes in earnings forecasts. And the authors note a few drawbacks here of analyst forecasts. The top one being that there could be bias in the earnings forecast because the analysts may be encouraged to try to make the earnings look good to earn brokerage commissions for their firms. But regardless, we have our 3 earnings strategies of the SU, the ABR, and the analyst forecasts. And the authors note to control for bid-ask balance, they skip the first 5 days after they form the portfolio. So if a stock is delisted in the middle of the holding period, they put the evaluated market index return in its place. And so the portfolios are rebalanced at the end of each period. And they've also calculated a couple of attributes at the time of the portfolio formation, for instance, the book to market ratio and cash flow to price ratio. And they track the 3 measures of earnings surprises that we discussed before. Okay, let's dig into section 2, price and earnings momentum univariate analysis. In section A, we're going to be discussing the price momentum. And so first off, they have a lot of measures that they're going to use to group the stocks into portfolios, and table 1 explains how each of those measures correlates. So let's go down to table 1. And so if you remember, the R6 is the actual compound return over the past 6 months. The SU was the difference in the current month's unexpected earnings compared to the earnings 4 quarters ago, and that's scaled by the standard deviation of that difference over the past 8 months. The ABR was the returns of the stocks minus the equal weighted market return accumulated over 3 days around the earnings announcement. And so the Rev 6 is the moving average of the past 6 months earnings announcements, revisions. And you note that even though each of the strategies is kind of similar and they correlate, the coefficients of correlation aren't very high. And so since the correlation coefficients are not very high, we could say that although these strategies are similar, maybe they're based on different information and they capture a company's prospects in different ways. So it looks like Table 2 is going to give us some more color on the performance of each of these strategies. So let's take a look at Table 2. So in Panel A, we have the price momentum strategy, where each of these portfolios is formed based on the prior 6-month return, with the 10th decile being the highest 6-month returns and the first decile being the lowest past 6-month return. And so this first row is the return of each of these portfolios over the next 6 months of a holding period, and we can see those returns increase monotonically. The next row we have the holding period over the next year after the formation date, and they increase monotonically as well. However, in the second and third years, you start to see that the returns of the lowest ranking portfolio is about the same as the highest ranking portfolio, and across the board, across all the portfolios. So the momentum strategy works in the first year, but after that, there seems to be no difference between the rankings of the portfolios. So digging deeper into the characteristics of the stocks in each of these portfolios, we see that the highest ranked portfolio tends to have the lowest book to market ratio, which means that these stocks are more glamour stocks or growth stocks, whereas the ones in the lowest ranked portfolio are value stocks. And this isn't particularly surprising because if you notice, the stocks in the top portfolio increased in market value by 70% over the past 6 months. And if book values don't change that drastically, then it would mean that the book to market ratio would decrease a lot over that time period. And on the other side of the coin, these companies in the lowest portfolio lost 30% of their market value in the past 6 months. So then the book to market ratio would likely be pretty high. And so looking at the cash flow to price ratio, the differences aren't as dramatic as occurred with the book to market ratio. We see that the extreme portfolios have lower cash flow to price ratios than the less extreme portfolios in the middle. And so these extreme ratios are lower than the middle for different reasons. For instance, the lowest ranked portfolios have poor earnings and cash flows in the past, so the cash flow would be lower compared to the price. However, in the case of the highest ranked portfolios, it's composed of glamour stocks, so their price is extremely high, especially due to the past 6 months return, and their cash flow is relatively constant. And so here the price part of the ratio is what's caused such a low ratio, and then here the cash flow numerator piece is what's causing such a low ratio. And the ones in the middle are less pronounced. And so the last three columns or panels of this table, panel C, D, and E down here, provide some more information about the source of the momentum profit. So looking here in panel C, the standard unexpected earnings, the SU, the ranking of the portfolios is strongly aligned with the most recent quarter's unexpected earnings. And the same thing happened around the ABR, where the abnormal returns over the earnings announcements is pretty high in the highest ranked portfolios and negative in the lowest ranked portfolios. Finally, the highest ranked portfolios, according to the past 6 months returns, are also aligned with greater revisions in earnings forecasts. So to sum this up, stocks with the most or the highest past 6-month returns and who end up performing the best over the next 6 months tend to be glamour stocks who have the highest unexpected earnings and abnormal earnings around earnings announcement dates, and also increases in analyst forecast revisions. And interestingly, this phenomenon doesn't just occur at the time of the portfolio formation, it occurs across future periods as well. Even in the case of the SU, it's even more pronounced in the next quarter. And interestingly enough, we note that the difference in the first 6 months of returns is basically 15% minus 6%, or about a 9% difference. And if we look at the abnormal returns over the next 2 quarters, which will be the 6-month period, then the combined difference of the first quarter and the second quarter between the top and the bottom portfolios is about 3.6%, which makes up almost half of the total 9% return difference. And so let's go back down to gain some more color on the analyst revision. We first note that all of these revisions are negative, most of them except the highest portfolio, and that's due to the common practice of maybe analysts being a little too confident, and so most of the time they have to revise their forecasts down. And this may be due to their incentives to earn brokerage commissions for their firm. And also a negative forecast may damage relationships between the firm and the management of the company they're covering, which may result in less maybe investment banking business. And so we see that in the period following the portfolio formation date, the analyst revision increase monotonically with the ranking of the portfolio. And it's been found in other studies that analysts are somewhat slow to revise their forecasts negatively, as they don't want to be the first messenger of bad news to damage relationships with management of the companies they're covering. And so throughout, since we've seen in subsequent periods different changes, for instance, to analyst forecast revisions, as well as differences in the abnormal return around earnings announcements, we could say that it does take a little while for new information to disseminate into the marketplace, and that may be why the momentum profits are occurring. Okay, so let's go down to table 2B, section 2B, where we will be discussing the earnings momentum. Section 2A was price momentum, and here we'll be talking about earnings momentum. So it looks like table 3 is going to be documenting the results of these studies. So let's go down to table 3. And so this table's pretty similar to the last section. However, here we have panel A. Well, so these portfolios are ranked according to the SU instead of according to their past 6-month returns, as was done in the previous table. So ranked with the highest standardized unexpected earnings, and then the lowest SU. And so we can see ranking by the SU ends up being fairly similar to ranking by the past 6-month returns, where we have a monotonic increase in the past 6-month return, and also the holding period of the next 6 months seems to monotonically increase as well. But the difference between the highest ranked and the lowest ranked portfolio is not as pronounced as it was when ranking for the past 6-month return. And over the first year, the difference between the top ranked and the bottom ranked portfolio is about 7%. And in the second and third year, there's the difference between the two is not as pronounced as was found in the prior table. And in the same vein, we see here that the highest ranked portfolios tend to be glamour stocks, and the lowest ranked value stocks, and the same results as the previous table, where the ends extremes tend to be lower than the ones in the middle, but this doesn't seem to be pronounced as it was in the previous table. And here we have the standard unexpected earnings, and you remember this table is ranked by the standard unexpected earnings. So of course we have the highest ranked portfolio has the highest SU, and the lowest has the lowest, and they increase monotonically. And as you would expect, the abnormal return around the earnings announcements also increases monotonically. And we can also see here the slow reaction to earnings news. For instance, the difference between the top-ranked SU portfolio and the bottom-ranked still shows a 2.4% difference, and a small difference in the second quarter as well. And so the total differences of these two quarters make up almost half of the total difference between the highest and lowest ranked portfolios in the first 6-month return. However, we see these differences don't persist for very long. By the third announcement and the fourth announcement are pretty much in line. There's not really a difference between the top and the bottom portfolio. Going down to the analyst revisions, we also see differences in the revisions to analyst forecasts from the top ranked to the bottom ranked portfolios. And these differences continue over the next 6 months. So the analysts are slow to revise their forecasts at a short holding time period as well. Okay, so now let's go down to table 4. Which gives us the results of portfolios based and ranked around the abnormal return around the earnings announcement. So we see in panel D the abnormal returns over earnings announcements monotonically increase over the portfolios, and that's because they're ranked as such. And we see by ranking the portfolios in that way gives us a similar result as if price momentum were used, where the past 6-month return is used as the rank. And so the next 6-month return for our holding period shows a monotonic increase. And the difference between the top and the bottom portfolio is about 6%. And over the course of the year, the difference between the highest and lowest ranked portfolio is maybe 8%. And this difference is less pronounced in year 2 and 3, but there is somewhat of a difference there. There's not really that much of a difference in the book-to-market ratios. However, we see the same occurrence as we did before, where the extreme portfolios have a very low cash flow to price ratio compared to the ones in the middle. And we see the standard unexpected earnings are monotonically increasing, as has been seen in the prior two the prior two tables. And here with the abnormal return around earnings announcement dates, which is what these portfolios are ranked on, we can see that the differences across the portfolios still occur over the next 2 quarters over the 6 months, but those differences somewhat dissipate over the third and fourth quarter. And so we can see here that since the returns here are so different across the rankings for the abnormal returns, and the rankings or the differences in returns are about the same as what was found when we were ranking in the previous table according to the standard unexpected earnings. So this conflicts with some prior studies that found that the SU was the ranking system that produced excess returns and abnormal return did not. But here we show that both the SU and the abnormal return around earnings announcements produce about the same results. And so the result of all this is that investors may tend to underreact to earnings announcements, but that underreaction is pretty short-lived over the next 6 months. And so let's go down to table 5, where the stocks are ranked according to earnings revisions. And we can see all of the things that have happened in prior ranking systems and tables is occurring here when we rank according to earnings revisions. And actually, this strategy of ranking by earnings revisions results in the highest differences in the returns across all the different strategies we've discussed. And it seems to continue on for the second and third years. And we can see the highest ranked portfolio tends to be growth stocks, like we found before. But interestingly enough, the cash flow to price ratio seems to be the highest out of all of the portfolios. The SU rankings tend to increase monotonically as in the current quarter as well as the next quarter. And the abnormal returns around the earnings announcements tend to increase with the ranking of the portfolios as well, as was found previously. And then those differences are gone in the third and fourth quarter. And since the revision analyst forecasts are what we're using to rank these stocks, of course we see that the lowest revisions are with the lowest ranked portfolio and the highest are with the highest ranked portfolio. So having looked at all of these different strategies, for instance, the price momentum strategy of the past 6-month returns, as well as the SU, the abnormal return over the earnings announcements, as well as revisions to analyst forecasts, we find that ranking these stocks according to each of those produces significant abnormal returns for the highest ranked portfolios versus the lowest ranked portfolios. But those excess returns are fairly short-lived over the first 6 to 12 month holding period. And we find that using each of those, or either one of those strategies, really produces about the same results. And so this might tell us that the market is typically very slow to incorporate new information into the prices of stocks.